Hi guys and welcome. In this video, we're talking about service accommodation and VAT. This is a massive one. A lot of people completely underestimate or actually just don't even take into consideration VAT when actually looking at their service accommodation, whether this is an owned portfolio or quite often in a lot of the clients that we're helping, it's actually more of a rent to rent. So where you lease it from a landlord and then you subsequently let it on. In many cases, a lot of these training courses they do massively overlook the VAT side of things and just how expensive and in some cases deadly VAT can be to profitability and your business model. So the first place we're going to start is the standard rate scheme. This is by default what applies to most businesses, but for service accommodation, it's usually not the best scheme to be on. The reason for this is you charge 20% VAT on your sales, you reclaim VAT on your inputs. Long stays over 28 days, typically excluded from VAT. You only have to charge VAT on the hospitality element, typically 20% of the supply, just to make good for the ancillary services, the cleaning, the linen, and that kind of stuff. So once your business exceeds 85,000, you have to 85,000 in a 12-month period. You have to register for VAT if your suppliers fall under the standard rate scheme. And the way it would work, a customer pays £100 a night. You would charge £20, 20%, £20 VAT on top of that. You basically add up the VAT on all of your costs as well, and what's left, you pay the HMRC. The reason this isn't a good option is the rent you pay to landlords, if you're doing this as a rent to rent or even a lot of your costs, probably don't actually have VAT on them where you're a service accommodation business. The rent, the insurances, all of this kind of stuff, a very, very lean business model. So as a result, you end up paying far more in VAT than you end up reclaiming, and it's a high VAT cost. So the only time the standard rate scheme we've seen actually be beneficial is if you are going after the contractor market, who you can just charge VAT on your supplies. They don't care, they can reclaim it. So if you're doing the business to business style service accommodation. But if you're going after individuals in the leisure market, the standard rate scheme is usually a big dent in your profit margins because customers can't reclaim any VAT what you're charging them. So they basically just see that you're charging £120 a night because they are sensitive to the VAT. But there is a better scheme available for a lot of businesses, and it's a flat rate scheme. So effectively what you do here is you'll charge 20% VAT on your sales still. So you'll still be charging that £120 a night. But what you do instead is rather than looking at all of your VAT that you've charged and then looking at all the VAT that you can reclaim on your expenses, with the flat rate scheme, you just pay a flat rate, 10.5% of the VAT inclusive turnover, with a 1% discount for the first year over the HMRC each quarter. But this isn't the best for many businesses because, as you can see here, when your VAT inclusive turnover hits or exceeds 230,000, you actually have to leave the scheme and you would then go back to the standard scheme or TOMS potentially, if your suppliers do fall under TOMS. To join the scheme, you have to have a current turnover, exclusive turnover of £150,000. And the downside here is you can't reclaim any VAT. So if you have any large purchases, that you can only reclaim the VAT on them if it's a single purchase and it's for capital assets over £2,000. But for a lot of people where you do want the certainty, as you'll see when we go about TOMS, the flat rate scheme can be a great option for many businesses as long as you fit within the parameters of the revenue before you have to leave the scheme. So how does it work? Total VAT inclusive turnover of £200,000, you pay 10.5%, £21,000 to HMRC. It's as simple as that. It does make it very easy to do your VAT returns and to budget for VAT because you just pay the flat rate. You're not reclaiming anything. TOMS is very much, I want to say grey area because it's not necessarily a grey area, but HMRC are challenging the application of TOMS, and historically TOMS has been the saving grace for serviced accommodation, but they are challenging the cases that are going through at the minute under this whole principle of material alteration effectively. If you're doing rent to rent, I'll start with basically saying that actually if you do own the units and you're using them for serviced accommodation, it's in-house supply, TOMS won't apply. Those suppliers won't fall under TOMS. As a result, you most of the time can't use it. But for rent to rent, TOMS can be an option as long as you tick all the right boxes. And if you do tick the boxes, you actually have to legally use TOMS. You can't opt out. But if your circumstances fit it, you can use TOMS. If your circumstances don't fit it, then that's when we'd look at the standard rate scheme or the flat rate scheme. But a lot of people kind of do ask me, Josh, what's the criteria? And there isn't a set criteria, but what you want is to give yourself the best possible argument in the event that you apply TOMS HMRC challenge, and as they are doing a lot of the cases at the minute. And it's all about this material alteration principle. If you're taking on a 5-year lease of an unfurnished property, furnishing it, branding it, letting it out on Airbnb as a short-term supply, because that is different. You've brought in a long-term let, 5 years, you've got a lease potentially, and you're letting it out on a nightly basis, then that is a different supply. So I can see HMRC's argument here. But what you need to do is, if you do want to be very confident in TOMS applying, you ideally want it to be the supply that you purchase in to be as close as possible to what you're actually putting out. And what that might mean is having the landlord pay for all of the bills, a short-term lease, maybe even for periods of less than a year, fully furnished, because that's just going to give you the best possible argument in the event that HMRC challenge it. And why would you want to be looking at TOMS? Well, TOMS comes in TOMS does have a lot of benefits. The first one is actually because it's your gross profit margin that counts for VAT registration. Actually, the VAT registration point at which your business has to register is significantly delayed compared to if it were being accounted for under the standard rate scheme, where it's literally just turnover in your books. As soon as that hits 85, you've got to register. With TOMS, it's actually your VATable turnover. So total revenue, less the direct cost that you paid to the landlord, 150. So in this case, this business wouldn't even need to register because their VATable turnover is only 50,000, despite having actual revenue of 200. And the way it would work here, so here 100,000, so their VATable turnover would be 100,000 in this case, and the VAT would be due on that £100,000 gross margin. So it can give TOMS can give a pretty similar result, because when you look at it for the service accommodation business model, usually it's about 50% profit margins is what we see with our clients. So actually, it can give a pretty similar result to the flat rate scheme. But the advantage of TOMS is actually it does allow you to scale your business with that. Whereas obviously with the flat rate scheme, as we saw, when you scale, you have to leave the scheme and usually go to the standard rate scheme. So what we'd always say to clients, look at your target market. When it comes to VAT and planning your business, if you've got contractors, furniture that you're going after the leisure market, you've got all these different businesses in one business, it can make it very difficult to optimize your service accommodation business with VAT. So if you do have different target markets, look at having them in different businesses. That can be an acceptable method, as long as it's not artificial separation for VAT. As long as they are different target markets, you've got different ideal customers. That can be an allowable reason for separating the businesses out. So contractors, look at that, because standard rate scheme, holiday lets, the flat rate scheme, or TOMS can be the best. That's what you need to look at in your business to make sure that actually you are optimizing it and ultimately reducing the amount of VAT that you pay. But one thing there is, I'll always mention this, a lot of people are just getting started in rent-to-rent service accommodation. They think they're going to scale to hundreds of units, but factor in the VAT as a cost, because we see it so often. Clients coming to us with what they think are massively profitable businesses, but actually, as soon as we start saying, you've got this VAT bill here, this VAT here, it does massively eat into the profit margins, and we've seen it actually turn profitable portfolios into loss-making portfolios. And also a massive one for anybody doing service accommodation where you own the units, make sure you're talking to your accountant about capital allowances. As long as it meets the criteria for a furnished holiday let, you can claim on all the integral features. And what we see, this is typically between 10 and 25% of the purchase price of the property can actually be identified as capital allowances and reduce your profit. So a lot of cases where you're doing a service accommodation and you own it, it could be 4 or 5 years before you actually end up paying any tax on those profits. That's definitely a good point to speak to your accountant about. And that's it really, guys. I hope you find this video useful. As always, do give it a thumbs up. It helps YouTube know this is good information. And if you've got any people that are doing service accommodation, aren't clued up on the VAT, help them out. Share this video with them. And that's it for today, guys. I'll see you in the next video.